Principles of finance, a la shmup. A little more precision. So the Apple option is dead, for now anyway, and you have your fingers tightly crossed that the partners' greed will pay dividends down the line. With bankers swimming in paper in the data room they've assembled to hold every piece of key information anyone could ever ask during the roadshow, you refresh your brain on the numbers. When Blade Runner Nanodrone was public, it had about $100 million in cash earnings. It also had $450 million going on $500 million of cash on its balance sheet when it was bought. Today, post-LBO, it has almost no cash, $700 million in debt with a coupon a bit over 7% and $50 million a year in interest payments. Well, BRND used to have $30 million plus in cash taxes, but much of that tax bill is gone now because the $50 million in interest payments took the operating profit of about $115 million down to about $65 million, on which BRND paid roughly $20 million of taxes. Or said differently, instead of costing the company $50 million a year, well, that debt after taxes really felt like it cost the company more like $40 million a year. But servicing that debt was still a meaningful cost, and the principal wasn't being paid down, at least not in any meaningfully fast clip. With a pre-IPO proposed market cap of $1.5 billion, this was an enterprise value of $2.2 billion. That is, the equity of the company was marked up in value a lot relative to where it was before the IPO, like almost double there maybe. Recall that it had been trading with 20 million shares at $50 each for a $1 billion trading valuation. It had $450 million in cash on the books, and it was generating between $20 and $30 million in cash each quarter, albeit with a lot of variability quarter to quarter, right? Like Christmas, people buy a lot of drones. So its equity value at that point was a bit over $500 million. Yet now, the street basically tripled that equity value. Why? What changed? Well, not much. The management stayed. The revenues were about on the same trajectory as they always were. The factory and infrastructure did, in fact, get upgraded. Some of the distribution channels were streamlined. Experts were brought in to manage the website a little bit better. The company saved another $1.98 a transaction with Visa because the private equity people were simply better negotiators for merchant accounts with banks and credit card associations. But all in all, not much changed, except for the build of the company's third product, the Thunderdrone. And if you were a shareholder of this company with the massive excitement around this brand spanking new third drone product, well, then you know that yes, Tina Turner, you do need another hero. At the $1.4 billion take-private price, the equity traded up to being worth $900 million, subtracting the $500 million of cash there. But now, basically, the same company's equity is worth $1.5 billion, at least according to the bankers. How did it grow over 50% all of a sudden? Well, lots of factors likely at work here. The stock market itself had been doing well, so it was trading at a 15% higher multiple. It used to be at 14 times earnings, now it's at 16 times. Okay, that accounts for some of the value increase. Oh, and also the PE guys told the bankers that if they couldn't bring it public at that floor price, they'd go to different bankers, their competitors, and there'd be no deal. Well, that little minimum price maxim changed things, and the bankers made sure to put it on the radar of every hedge fund and mutual fund that they deal with, and that's pretty much all of the hedge funds and mutual funds in the world. And who becomes a hedge and/or mutual fund manager? Geeks, mathy geeks. Yeah, they're a very solid demographic to love this toy. So the fact that the company went from having one sleepy analyst covering it to now having a half dozen on board as part of the IPO syndicate, well, the company simply earned a higher multiple without changing much of anything fundamental. Great press, big public relations mumblings, buzz, and oh, there was one other thing. The bankers have their own reputation to think about, and the math matters here. So when they pushed the PE owners of BRND for estimates, the PE guys gave big up-number estimates, meaning that they told the bankers the company would grow from growing revenues at 2% to 15% in just 1 year on the back of huge Thunderdrone sales. Then they showed them the drone cam video of the thing swimming with sharks at the banker meetings, and then swimming with actual sharks in the ocean. Well, one ran into a squid and made calamari. Another found gold. It was magic. All right, well, the company will be a bit diluted in selling equity, and with the deal feeling hot, it's likely going to sell more than 10% of itself to the public, probably more like 15%, but maybe at a bit higher price than the $50 base case of 30 million shares that are outstanding. Maybe they finally do the IPO at, $60 a share and then sell 5 million shares. Well, that wouldn't be terrible horrible dilution, and the raise then of $300 million takes massive pressure off the debt load, shrinking it on a net basis from $700 million with virtually no cash on the books to $400 million in net debt. It also gives breathing room for BRND to spend a bit more on marketing Thunderdrone if they want, maybe expanding the market itself, and a really nice holiday party. Yeah, sausage this time, not potatoes.